I've made this case before that it's not impossible for the S&P to break the lows of October last year. And I say that because of the relationship between equities and treasuries, top 20 drawdowns. We don't know if the drawdown for the stock market, the S&P, is over because we're still in it and we haven't taken out the prior peak. Okay, I don't know why that's still so fantastical to people to think that you can revisit the October lows of last year for the S&P and even the NASDAQ when small caps, the Russell 2000, just did it last week.
We're speaking on Wednesday, November the 1st, and the Federal Reserve has kept rates unchanged. The dollar is up, the 10-year yield is down, the S&P 500 rallied. What does this all mean? Joining us today to discuss this is Michael Gayed, Portfolio Manager of Tidal Financial Group. Welcome back.
Always a pleasure. And by the way, the view from your vantage point is exquisite.
Thank you. Thank you for being here and showing up. Let's talk about what happened today. So no surprises for the markets because it was priced in that the rates would be unchanged. However, the S&P 500 did rally on the news. So what about the statement indicated risk-on attitude or appetite, I guess, from the Federal Reserve?
Well, I think it's the standard answer, which is that if everyone's expecting the Fed's going to pause here, then it's not going to just be a pause. It'll be the end of rate hikes. And the knee-jerk, Pavlovian response is, well, then we got to buy stocks, right? And it's interesting because the buying of stocks, again, goes back to the same large cap, Magnificent Seven type of names, at least on the initial reaction as we're chatting. Small caps are still negative. Retailer stocks are still negative on the day. So it's not clear to me if this is just algorithmic or if this is a change in investor psychology. Having said that, it is curious to me that you have strength in treasuries. You have still fairly decent strength and holding up in gold, which had a pretty big move in October. And you have defensive posturing beneath the surface in terms of utilities still performing pretty well. So I look at the intermarket dynamics. I say to myself, first of all, it's just the initial reaction. It may not mean very much to begin with, but there's still a lot of interesting defensive posturing, which I'd argue is totally against the seasonality case, at least for now. Again, I could be wrong. I mean, last week I said I think we may see circuit breakers get hit this week. It's only Wednesday, okay? But a lot of the intermarket dynamics that I track and all the concerns I have around Japan as a stress point, I think are still valid.
Well, let's just discuss the obvious. So the Federal Reserve kept rates unchanged for the second time in a row since the beginning of summer. Is this the end of rate hikes?
It's going to depend on credit spreads. So I always go back to this point that the Fed does not really care about the stock market. They care about the differential between junk debt and high quality AAA paper, because if that differential widens, that suggests that there's real credit strain in the markets, in the economy that's coming. So that is starting, by the way, to happen, meaning you're starting to see at the margin high yield not perform as well relative to higher quality in this most recent move. Even today, from what I last saw post-Powell, there's a little bit of widening taking place. Now, usually when credit spread widening takes place, it happens very suddenly and aggressively, and it tends to not give people too much time to position for it. The Fed is not going to lower rates unless they see credit spreads widen, which means that at the end of the day, the Fed is simply following the bond market.
Right. Okay. Well, let's discuss specific market action and reaction today. Like I mentioned, S&P 500 is up. You talked about small caps being down. Why is it that the long end of the curve, I'm talking about the 10-year, is down and the dollar is up? Why that divergence there?
I mean, it sounds like few understand this from what you're saying. Well, first of all, that is also consistent with risk-off behavior. Right. I mean, when you see safe haven plays getting a bid into what looks like a strong update for, in quotes, the market being primarily the S&P, you got to be careful because the message is something different. Look, I do think it's true that the ECB is likely to lower rates sooner than the Fed. So I do think there's some pricing in now, currency-wise, in terms of the idea that we'll probably in the U.S. hold rates while other, in particular the Eurozone, starts to lower rates from the European Central Bank. But there is a safe haven bid that's happening here. I mean, it's more than just, dollar is strong. It's like, why is the dollar strong? Probably because there's some kind of fear. Now, again, I'm going to keep going back to, I still think Japan is a very high risk in terms of volatility and some kind of currency crisis with the yen. If the dollar is strong because there's some concern that the yen is going to go through some kind of spike up or spike down, gap down. It makes sense that, at the margin, money would favor the US dollar against the euro and most other currencies, right, as a safe haven trade in the short to intermediate term. So I keep going back to, it's like everyone's focused on Powell. Powell doesn't matter at this point, which is not a very popular opinion. What matters is the Bank of Japan.
Okay. Any news, updates from the Bank of Japan since last we spoke regarding this issue?
I mean, other than the fact that it seems like whatever they're attempting to do in terms of tweaking policy is not saving the yen just yet, right? Is I think sort of the main point. They're going to keep on trying, and I know people say, well, listen, all this is still bullish for the carry trade, and you and I have talked about this idea before. This idea that the reverse carry trade is ultimately a catalyst that could send everything tumbling, the so-called global margin call. I still think they're going to have to step in and do something aggressively if they're not, if whatever they're doing now isn't really working, which seems to be the case. Look, I get it. The argument of seasonality is strong, and as I've said before, I believe in seasonality as well. The problem is people, I think, are getting fooled by not only the same idiosyncratic risk that drove, in quotes, the market, which is really just the S&P and NASDAQ higher, but they seemingly are forgetting still the lags when it comes to the fastest rate hike cycle in history, okay, which is, again, is hitting right about now. So the tail risks are still there, right? And keep in mind, for those that are listening and still bullish into the end of the year, okay, you didn't have seasonality in 2018 when you had the Christmas Eve massacre and the Dow was down 1,000 points. Everyone thought Christmas would suck back then. You didn't have it seasonality last year. December was the fifth worst December for the stock market in history. And when you line all that up with everybody's seeing the same thing around seasonality, everybody's saying the Fed pausing is bullish, and nobody really understanding just how serious the Japan scenario is, that seems like how you have a rug pull. That seems like how you surprise people at the exact time they're most optimistic.
Yeah, it was. You made the analogy. It was like the something is like Mothra, and then you got Godzilla coming on. Well, Mothra's going to save the day. Godzilla's going to destroy us. Okay, so listen, you've been calling for things to get really bad in the markets for quite some time, and then followed by some sort of melt up. Well, the stock markets, as you talked about, have been actually on a decline since early in the summer. I can't remember when we spoke last. I think it was 2 months ago or a month and a half ago. But basically, ever since the beginning of August, late July, we've had a huge drawdown in the major indices. So let's recap what happened there. Was that decline in line with your expectations for the year?
I mean, yeah. So I mean, just to clarify. So January, I said it's likely going to be a melt up year because it's a pre-election year, but that at some point towards the end of the year, you'd have some kind of credit event, right? Now, I never imagined the credit event would be Treasuries, right? In the way that Treasuries on the duration side just completely collapsed in price and you had this yield spike. I said September 1st that Treasuries are the credit events. I mean, I have that on my timeline. After in August saying I think Treasuries are going to run, it became clear to me that Treasuries actually were the phase one of the credit event. Phase two is corporate credit spreads widening, which again, I think is starting to happen. So it's actually been playing out pretty correctly. And I'd argue that this has been a really ugly year. I mean, I've made this case before that it's not impossible for the S&P to break the lows of October last year. And I say that because of the relationship between equities and treasuries, top 20 drawdowns. We don't know if the drawdown for the stock market, the S&P, is over because we're still in it and we haven't taken out the prior peak. Okay, I don't know why that's still so fantastical to people to think that you can revisit the October lows of last year for the S&P and even the NASDAQ when small caps, the Russell 2000, just did it last week. The thing that's amazing to me is you still have this ongoing bullish narrative when the breadth remains absolutely terrible beneath the surface, right? And that tends to be sort of a warning sign for, in quotes, the generals falling to the soldiers. So it has largely played out, obviously nowhere near perfectly. It has largely played out the way that I thought it would. I never imagined you'd have a tale of two markets where it's, basically large caps driven by 7 names and then everything else looking like an outright continuation of the bear market that started in 2021.
Could you make the argument that stocks are down because yield, particularly the long end of the curve, were up?
Yeah, I think the speed, certainly. I mean, look, the simplest answer is the right one. Why is it that small caps keep on getting hurt so badly? Because the reality is they're the most levered part of the marketplace in terms of small, mid, and large cap, right? So if they're going to roll over their debt into higher for longer, then you better believe that's a headwind that hurts the entire space, because there's a lot of these zombie companies that are smaller that probably can't survive on razor thin margins, having to pay up now at a much higher interest rate, right? So I do think that there's a lot of logic to that. And the other thing is too, it's like, it really is wild to me. I tend to not focus too much on valuation because I'm much more, in terms of the way I think about things, intermarket and behavioral. I'm blown away by like the Magnificent Seven, price to earnings ratios across the board. I mean, you're talking about, mega cap companies which have price to earnings valuation metrics which are obscene. And the funny thing is that people always say that when it comes to investing, hope is not a strategy. But price to earnings expansion, PE expansion, elevated price to earnings ratios, that's hope, right? So it's hope that they're going to grow into that, which is why the PEs are so high. So at some point this stops. At some point the movement and the idea that these 7 names are safer than U.S. government debt, at some point that will stop. And when it stops, it probably stops in a very aggressive and sudden way.
Okay, well, the policy statement released by the Fed today, one of the statements is that economic activity expanded at a strong pace in the third quarter. First of all, do you agree with that?
Well, I mean, I think when you dig a little bit deeper, and you end up seeing a lot of it is probably more driven by government debt and borrowing and activity, right, than anything else. But also, it's like, all right, all these metrics often get revised lower. So I don't think GDP matters one bit. I don't think any of these metrics matter. And the markets are forward looking. Look, we were trading below the 200-day moving average on the S&P for a bit of time, and I think now we're above it, right? Generally, when you're below the 200-day moving average, you tend to have volatile markets. So what we've seen the last several days is actually pretty par for the course, right? It's been volatility driven by where you are relative to the 200-day moving average. And by the way, still a down sloping average. Typically, when you're below the 200-day moving average, the vast majority of the time you're in a recession, you're below the 200-day moving average. So who cares about GDP, right? If you use the 200-day moving average as a tell on the economy, in terms of what the stock market's telling you, I would actually argue that GDP doesn't mean a damn thing. And, we probably are going to have a recession sooner than people realize.
Okay, and what does this mean for bonds, specifically the yields and then the price? So the 10-year yield reached 5% earlier in the month, October. That's the highest it's been since, I think, in the last 17 years. So, yeah. Michael, the price has been hammered. What's next?
Yeah, and to be clear, it's like, I am bearish on bonds, right? I'm bearish on corporate debt, right? This is the credit, phase 2 of the corporate credit spread widening. I put out this post on X before. I said it's not a question of whether yields have topped or not on the 10-year. It's a question of whether the flight to safety trade has bottomed. Flight to safety trade meaning credit spreads widen for a moment in time, VIX spikes, and money goes into the quote-unquote safety of government debt because the U.S. government can't default. This is the whole concept of the flight to safety trade, which, again, I need it for my own funds because that's what they're designed to try to play. That's been the missing ingredient, has been Treasuries responding to widening credit spreads, which never happened throughout this. So it could very well be that we may have seen a short to intermediate top in 10-year yields, but that doesn't mean that corporate yields have topped, right? If you have credit spread widening, those will keep selling off. Yields will rise on that end relative to Treasuries, which by comparison would look like they're a much better place to be.
Okay. Now, you mentioned this credit event that could come from Japan. Could you foresee a credit event stemming from the U.S.?
You're in Canada, right?
I am, yes. Or yeah, Canada.
Okay. If that happens, I'm going to go to your flat and we're going to hang
please.
out. I do not want to be anywhere near that scenario in the U.S. Think about the implication on what society would do if suddenly you have
well, describe what's in your mind right now. I'm just thinking about, corporate spreads widening, but you've got a gloomier scenario that's probably in your mind. Describe what you're thinking about.
Right. Well, what I'm saying is, like, let's say you had let's say these prognostications around Treasury yields going to 8, 9, 10% very quickly are true, right?
Who's prognosticating this, by the way? Who's saying 8, 9%?
It's a lot of basement squiggly traders.
Okay, all right.
Right, but what I'm it's like people forget the entire system is predicated on Treasuries, right? The risk-free rate. So it's like, all right, so if you have a sovereign debt crisis where the United States is the source of the sovereign crisis, I'm pretty sure the financial system is toast because they use Treasuries as their safe collateral that all the leverage is collateralized against, right? So let's hope that that's not the case. I will say, though, that it is interesting that the dollar, again, keeps rising, that gold has had this big run. Bitcoin as well, even separate from the Bitcoin ETF excitement out there. There's something else that's happening here in that it seems like the marketplace is starting to try to hedge against counterparty risk, which is the only reason I can think of as to why gold has done suddenly so well in October, and Bitcoin, which is more of a speculative play, did end up diverging the way that I thought it could relative to risk on assets by actually going up. I do buy the argument that Bitcoin and gold are counterparty hedges. So the question is, what is it that those traders or investors are worried about from a counterparty perspective? And let's hope it's not a sovereign debt crisis in the U.S., because I promise you, you do not want me to be your roommate.
I don't know about that. You seem like a nice guy, but I get your point. Nobody wants a credit event happening. Looking ahead then, are you still predicting a melt up? I mean, I guess it happened already, but this decline from the S&P's high since the beginning of the summer, or the middle of the summer rather, can we see a rebound from here? We're not.
Yeah, it's really possible. It's like, and I always go back to it's about conditions, but I'm just pushing back on the seasonality argument, given things which are not behaving according to the seasonality pattern. This is not my opinion; it's just fact. And I've made that point before. You look to the 1920s. You look on average, what month of the year does the S&P tend to peak in? 8.3%, not because it's 1 in 12, it just so happens, but 8.3% of the time, the markets do peak in July. So this could be one of those times, right, where the market actually did peak in July. 40% of the time, the market peaks in December. So I get it, right? I mean, the historical odds actually do favor that you're probably going to close towards the highs of the year. But I don't know if we have anything in history that tells us what can happen, given how unusual the intermarket dynamics have been, given the fact that small caps have been so terrible, the fastest rate hike cycle in history, and everybody being convinced that just because something happened in the past means it's going to happen now.
And this recession that you talked about, is that going to coincide with a further decline of the equity markets, you think?
Yeah, I mean, most likely, right? I mean, again, I go back to if the higher for longer theme is real, and small caps keep weakening because of the expectation that they can't survive and roll over their debt into the zombie companies, into the higher rates, I'm pretty sure you're going to have one hell of an unemployment rate spike.
What are you talking about these days in your lead lag report? Use the link down below, follow his work. Give us a synopsis of some of your latest research.
Yeah, I mean, as you know, a lot of the work that I do is quantitative, separate from the whole loudness and persona of X, right? So it's weekly risk signals, a lot of macro work I've been putting out there, high yield ideas as well. There's going to be some really interesting high yield opportunities if I'm right that we're on the edge. That's somebody who wants to be a subscriber to the lead lag report, by the way. That's going into no, but there's a lot of work that goes into the idea and sector analysis as well. Right now, the overarching theme in the research that I've been putting out there is it's very clear that intermarket relationships are saying play defense. Defense, I keep going back to, means not shorting, means not puts. Defense means lowering your beta, utility staples, healthcare. From a sector perspective, defense means treasuries, which again have not been defensive until they suddenly start acting defensive.
Yeah, can you just comment on that before we close our session today? Why is it, I didn't ask you this earlier, but it's so obvious, why is it that the treasuries have been declining in price, yields have been going up, while the equities have been coming down? Shouldn't the treasuries, a 10-year, been in a defensive play against, equity volatility?
So that's the thing I keep stressing. Treasuries are not a hedge to the stock market. They are a hedge to credit spreads and heightened volatility, which is why it makes them look like they're a hedge to the stock market. I keep going back to this is what everyone gets wrong about treasuries, and it drives me crazy because I know what the path behavior historically looks like. The link is not around treasuries protecting stocks. It's in that flight to safety when there's fear about default risk. And unless you believe that cause and effect is broken, which maybe it is, okay, but unless you believe cause and effect is broken, interest rate hikes like this cause increased bankruptcies. Full stop, right? And you're seeing it, by the way, in the private economy. You have not seen the junk side yet respond, but at some point it will. And when it does, I am going to be wildly annoying.
We got a couple of minutes left. I have to close off on your award-winning lumber to gold ratio. Let's talk about that. What's new in the ratio? Well, the lumber futures I'm looking at has been kind of flat ever since the beginning of the fall. Gold has spiked dramatically, as you know, since the beginning of October. So I'm guessing the ratio has compressed somewhat. What does this signal?
Right. Right. Yeah, exactly. And by the way, it's coincided with home builder stocks also, being weak, right, overall. So it's the same message. The message is very clear, right? I mean, housing starts are likely to fall. There's credit contraction coming. That's what lumber to gold as a relationship tells you about. By the way, not my opinion. Again, it's not some magic relationship. The tie-in is around housing starts. Lumber is tied to housing starts. Gold is tied to risk off. So you compare the two to each other. It gives you some messaging, right? And actually, the frustrating thing for me is that ratio has largely been right in saying be careful. What has failed so far is treasuries. Maybe that's about to change. That really explains a lot of what's happened in my RORO ETF in particular. But the broader point is, I mean, everything right now is still saying risk off. Everything is still screaming, just again, as everybody's screaming about seasonality. I would rather trust leading indicators that I can backtest that have probabilities attached to them than trust random lines and those that simply are not even able to identify as to whether those random lines tell you anything about the future.
Okay, final question. Give us a positioning congruent with your risk-off thesis.
All of my funds are designed to play risk off through treasuries, which has been my own hell as a portfolio manager of rules-based funds that would run the exact same way if I died tomorrow. Now, having said that, it's clear that the dollar was I really the last 2 years the best risk off play. Gold may actually end up being another really good risk off play, right? And you're starting to see that, I think, with that movement. I've made that point before. I think gold can break new all-time highs this month in November. I think it's very possible to come right around the risks. Utilities are showing signs of strength. So if you're an equity investor, that clearly is showing some relative strength now after getting bombed out. And I go back to nobody believes treasuries are a hedge, which is probably why they're going to be a hedge.
Okay, we'll look forward to that. We'll follow up again next month. Thank you very much, Michael, for coming on again in November, 1st of November, first guest. Appreciate you recapping the Fed for us. Follow Michael at the link down below to learn more about his research at the award-winning Lead Leg Report. And, of course, Michael's on X, Twitter. You can follow him in the link down there below as well. Congrats. You got your Twitter follower keeps growing. So keep it up.
It's probably a lot of haters. I think it's probably I'm a very endearing personality.
That just means you're doing. If you got haters, it just means you're doing something right in life. So anyway, congrats again, and we'll speak again soon. Thanks, Michael.
Thank you.
All right. Don't forget to like this video and subscribe. Take care.